I don't have too much of fixed deposits with me, but I do have a big chunk in my provident fund because of so many years of working. I have one property. I don't have too much of gold, just about 3-4% gold. So all that becomes a part of my safe assets. And then I have a massive chunk in the not that safe asset category also, with most of it going into equity. I don't have any crypto. I don't have any other structured deposit. But if there is this person, and let's say the money that he's able to save is about 25,000, uh, I would definitely, kind of advise that person to start looking at a nice mix of maybe 5 SIPs. So put 5,000 in 5 SIPs. If I have to name a few funds, I'll probably, at the top of my head, I would say Parag Parikh Flexi Cap. I would definitely advise a momentum fund. Then I would suggest a mid cap fund, can be anything, but ideally it'll be a growth fund, can be an Access mid cap or a Motilal Oswal mid cap or stuff like that. One small cap fund should definitely come in. And the fifth one is like, your trump card. You can do it for anything, whatever works for you. I would ideally say use it for a Nasdaq 100 or an S&P 500. So get that exposure there. So if you really look at it, how I've done it is I have actually done my 50, 25, 25, and I've also done my 70, 15, 15.
Hello, everyone. Welcome to the podcast. This is the first episode on my channel, and I'm really honored to have someone who I've personally learned a lot from, Mr. Shankar Nath. He has almost 2 decades of experience, and I'm sure a lot of people who watch my channel also know of Mr. Shankar. So, Shankar, first of all, welcome to the podcast, and thank you so much for accepting my invitation to be here.
No, thank you, Rishabh. Pleasure's all mine. Thank you for having me.
So one of the things I personally love about watching your content is the way you break down the analysis, the research that you do. And also, like I do marketing. So we always say that always trust someone who has a lot of data. And one thing I know that you had access to a lot of data as you were working for 7 years with ET Money. And before that, also in the same industry. So really valuable experience that you're building, you're bringing to the community. So very grateful for that. How do you see this industry evolving as a whole in terms of people learning about personal finance and then content creators creating content about these topics?
So I think this is still an exploding stage. There's no dearth of content, and there's no dearth of people wanting to consume the content. Uh, a lot more people are making a lot more money now as compared to what was earlier. I remember my parents' time, it was a salary of what, some 500, 600, maybe $1,000 a month or something. Today, these numbers are unknown, right? You go out and you spend so much. So this is only going to go up. And wealth management, and now you're getting a lot of different layers as well, right? So earlier, everything used to go into a bank fixed deposit. Now, the latest news that's come up is that the bank fixed deposit amount has actually gone down, and a lot more shift is happening towards equities, towards mutual funds, PMS, alternate investments, even crypto to some extent. So money is getting scattered everywhere. There are more choices now. There are more people who want to build awareness towards this thing. And I think as an industry, it's just going one way. It's going up.
I think that also like brings me to a follow-up question because you mentioned all of these asset classes and we both speak about diversification. And I think one thing that we all agree on is that diversification is your best friend. The more you diversify, the better you can manage your risk and so forth. But at what point does it become too much of a diversification, right? So what's that point where you say, okay, this is what I need and this is the percentage split. But beyond this, someone says, I have a bottle of wine which is 1,000 years old. Would you like to invest in that? I mean, at some point, it's like over diversification or a bit over optimization rather. So how do you define that point?
So there are broadly two categories. You've got your safe assets and you have your not that safe assets. So safe assets is what I would define, would include your savings account, your fixed deposits, even gold can be a part of it. Property definitely is a part of it. Your provident fund, that you put in voluntarily and the company also contributes to it. So all this becomes a part of your safe assets. And then you have the not that safe assets where I won't call it risky per se, but it's more of a higher level of volatility that comes in. This is where your equity comes in, your crypto comes in, you've got REITs, you've got all kinds of other instruments that are there, structured products, currencies, and all that stuff. So for me, it's just these two levels. This is the first level of diversification. Then beyond that, you kind of have your preferences. So for example, I don't have too much of fixed deposits with me, but I do have a big chunk in my provident fund because of so many years of working. So I keep that there. I have one property. I don't have too much of gold, just about 3-4% gold. So all that becomes a part of my safe assets. And then I have a massive chunk in the not that safe asset category also, with most of it going into equity. I don't have any crypto. I don't have any other structured deposits. So that's how I think a diversification should be done. You should not have too many instruments within your structure. So it's not that, some people have this urge, Rishabh, that, hey, I have invested too much in mutual funds. So now let me try stocks. And then when you are done with your stocks, also you're like, okay, let me try out PMS. That seems something very new and interesting. See, new and interesting is not should not be your criteria to invest. It should be more in terms of your risk return matrix. That hey, if I am taking a little more risk, then would I get a commensurate or a higher amount of return on my asset? So that's how I kind of lay the land that A, split it between safe and not that safe assets, and within each of these boxes, try and have 2 3 instruments that you understand and that you feel fits into your structure. So that's the easy way of doing diversification.
Right. Yeah, I mean, I got a comment once on my channel where someone said I'm very diversified because I have mutual funds, but I also have index funds and I also do swing trading and I also buy small case. Essentially, it's all the same asset class, which is equities. So you also mentioned in one of the videos that you did an analysis of putting your money in the Nifty 50 versus putting your money in the Nifty 50, 50% of that, and then also into gold and debt. And you eventually ended up with the same 12% sort of a return rate over a very long period of time. So there are two things to that. Of course, it's better to have a diversified portfolio because you are ending up with the same returns. On the other hand, someone might also say, what if I just do the equities because I'm anyways getting the same percentage return? Of course, my answer to that is always that you're getting it with less volatility, with less risk. You sleep better at night. But when one does some analysis like this, what are the other things that they should consider? Because oftentimes the percentage return, at least this is what I feel, is not the only metric. It's also important which portfolio split can you hold it for the longest period of time, right? So
Right.
how do you do that analysis if you're just like a beginner investor?
Yeah, so a couple of things. One is your investing cannot be very different from your reality, from your life. So for instance, you might require money at some time. So what do you pull out of? Do you redeem your equity at that time, or would you prefer to have certain safe assets, like let's say some money in an FD that you can easily liquidate and use it for your needs? So this is something that happens all along. The second interesting thing that comes along is that wealth creation is never going to be a linear line for you. It goes up and down, but how much up and down do you want it to go through, right? Volatility. I mean, I have seen times where your I mean, a single year return has been like 55% negative. So imagine losing half of your wealth in a single year. Can you consume that? For a lot of people, the answer would be no. That, I really don't want to create a portfolio where my money can be off over a year. So that happens. Even now, what's happening? A lot of people, I never used to get comments when the market was going up. But now, when the markets are a bit shaky, it's 15% down from its all time high. I get a lot of questions. Shankar, what is your view on this? What view, man? It's just that the price is down, but as long as the companies are doing well, the earnings are doing well, you really don't have too much to bother. But yeah, that's the nature of the beast, right? It's going to go up, it's going to go down, and it's how much you can stomach. That's how we look at it. But yes, it's always better to have that split of assets with you. You sleep better, definitely. And as I've seen all along, you end up making somewhere close to that. Mathematically,
Yeah.
it might show that small caps are so high. I mean, if you had put it in 10 years, you would have made so much of money and all that stuff. But that's really not how we work, right? We have our preferences, our bias. Investing is definitely a very preference based exercise. It's not a mathematical exercise. There's a lot of art and science to it.
Right. I was reading in the psychology of money as well that, no matter how much we tell people, just rely on the data, this is how the math works, people end up making decisions based on their personal circumstances and situations, which is what happens with everyone. So it's better to then say, okay, this is a great portfolio that I saw on YouTube. but this is a portfolio I can sleep with for the next 10 years or 20 years. So I'm just going to go with the second option. But speaking of mathematics, one thing I realized is a lot of people find it hard, for example, to visualize compounding or to visualize what happens in the longest period of time. But there is one thing that all of us, I think, in the personal finance space, we agree on, which is the equation of compounding, the equation of the future value of investments or the future value of SIP. And there are different variables in this equation, the most important being the amount you invest, the amount of time you invest for, and finally the returns percentage that you get. And there are different variations of this that, you've also given examples of the 15-15-15 rule. Then I think in one example, you also mentioned if you were to invest 1 lakh for, I believe, 20 years with a 12% return rate, you end up with 10 crores. And you can do the same thing with a 30K plus a step up on that at 10%. So I think like a lot of that revolves around understanding how this equation works. So if people, who are starting to invest, if they were to understand this equation, I think they would win half the battle. Right. So I want to go with you like through this equation one by one, all of these three factors in order of importance and what one can do to improve their overall wealth corpus. So the first one is the amount invested. The second one is the time. And the third one is the percentage return rate. So can you share some quick tips on each of these? And then I can add my inputs as well so that, someone who's starting off can visualize the math before they start investing.
Yeah, so if when someone is starting off, let's say someone is in their 20s, for example, okay, they just want to start off with things. My first advice is don't focus on the return. And this is where a lot of people make the mistake, right? They are always focusing on the return that, what's that one instrument that can give me 20% per annum or 30% per annum? When you're young, when you're starting out, don't focus on the return, focus on the initial capital. That's more important. So, and that makes a world of difference, right? So instead of 10,000, if you can put in 20,000 a month, you'll actually see the compounding go in your favor, even if you are making only 12% per annum as compared to 30% per annum. That is the first advice I'll give. Then, as you move along to, let's say, your 30s, etc., then there's already a corpus which has been created now, right? So that gives you a little bit of assurance that I have some money already in my safe assets. So if something really goes down, I really don't have to be bothered as much as I would have otherwise been. So in your 30s is when you start looking at, okay, can I up my returns a bit? Can I look at some alternate strategies like I'm a fan of factor investing, and historically it's proven that factors have done better than market cap based indices. So can you move into factors? Can you move into stocks which are more in the small cap and the mid cap space rather than looking at only large caps? So in your 30s, in your 30s, in your 40s, that's when you become a little more aggressive with the returns. So initially start with the capital. That's more important. Over time, you start moving into the returns. I'm kind of simplifying it, but honestly, if I have to give an advice like an elevator pitch, I think this is what I'll say. So start with your initial capital, try not, and this has to be a pursuit of your life. You just can't. I feel sorry sometimes when someone says, Shankar, I've quit my job to become a full-time trader. I said, what was the need of quitting your job? I mean, you could have made 15% per annum as an investor and let that fund manager do his job. You're paying him 50 paisa for doing his job and let him grow your wealth to about 15%. And you can continue with your active work. There's no, unless you don't want to do it. But if you really have a option, then go with both. So I think that's how this works here as well. That do both, concentrate on your capital and keep on concentrating on your capital. And when you're in your 30s, that's when you start looking at the returns as well.
Yeah, and I think that's the example that you gave is just getting it exactly the other way, right? So I want to maximize my returns, but so the person wants to trade and maximize the returns rather than make
On your
consistently
capital.
higher
Yeah,
income. Correct,
exactly.
correct. And this is something I also speak about because, I've always focused on like my biggest metric is how much money I have put in the market. So
Right.
like that's the metric that I'm really obsessing about that, if I can put this much more, if I can put this much more, so that's the metric I'm chasing. I'm 35 now. So now I think, as you said, we're going to get into the conversation about factor investing, which is like one of the most commonly asked questions on my channel because I speak about index ETFs.
So Rishabh, one thing at 35, you're getting into that age where the percentage return will not matter to you when you look at your portfolio. You would be more
Yeah.
interested in seeing how much of money I have, how many crores, how many dollars I have in my portfolio. I
Yeah.
think that you're at that stage now. Yes.
Correct, correct. So I also, I did my own maths on the same calculations that you've given as examples, where I saw that if I put 2 lakhs a month, so I run a business, I can increase my income. I'm putting 2 lakhs a month right now. If I put 2 lakhs a month for 25 years at a 15% interest, so I'm making a diversified portfolio with some mid cap, with some small cap, targeting a 15% interest, it'll come to around 86 crores. And the further I go, so for example, if I add just one more year, I make it 26 years, it's going to cross 100 crores. So that's the last factor that we did not touch upon, which I just wanted to add as this example, is that at that level, the time really adds to the money, right? So one more year is going from 86 crores to 100 plus crores. And I think this is important because oftentimes we will leave this for the end, but actually we have to get to that stage by consistently investing in the long term, right?
Correct.
So the next point is about the two fund portfolio, right? So this is one of the popular videos on your channel, and I've watched it myself as well. I don't have those two funds in my portfolio, so that's why the question. If someone comes to me and says two fund portfolio, I'm more like Nifty 50, Nasdaq 100, probably those two, or Nifty 100, Nasdaq 100, or Nifty 100 and mid cap 150. And your answer to that would be one momentum and one value fund. So I want to learn more about that. Like, why is that the option? I do understand that both of them correlate really well in different market cycles. But my perspective on this is I understand something really well, which is that the economy will grow, India will grow as a country, hence the companies will grow. And the logic makes sense for me. I do understand that I'm living with a 4% less return, 12% versus like 16 point some percent in a momentum plus value. But it's just that logically, I've still not been able to convince myself that a company that is in momentum is going to continue to do well, right? Like just logically, I'm not able to convince myself, even though all the data points to that fact. So what are your thoughts on that?
Yeah. So, even if you're a fan of market cap based indices, a market cap based index also has a lot of momentum inside it because it's market cap based, right? So if some particular company has a jump in its stock price, let's say it grows up by 30% over the year for some reason, it's going to get a higher weight in the index, correct? Because
Yes.
that's how a market cap weighted index also works, right? I'll give you a genesis of how this momentum and value strategies came out, and then I'll connect it with some other concepts. So it'll give you a better idea. So I was researching on momentum strategies, and I was reading a nice article, a study kind of thing. And somewhere at the bottom of some obscure paragraph it was written, momentum and value are weakly correlated. And that kind of was a light bulb moment for me because I was like, okay, momentum is equity, value is equity. Normally we say, okay, equity and gold are weakly correlated or negatively correlated, etc. But here's someone who's telling me that there are two equity instruments which are negatively correlated. I mean, not negatively, but weakly correlated. So that's what triggered the thought process in me that can this be a great portfolio that gives me stability, number one, and secondly, it's also able to give me growth because it's equities at the end of the day, right? So that's how the genesis was. Also, what happened is at the same time, I was working on something called the GOP strategy, which is growth at reasonable prices. Now, look at it from your perspective, Rishabh. You want growth and you don't want to overpay for some security or for some index, correct? That's how everyone wants to work, right? So you want your money to grow. You don't want to pay too much for a particular asset, right? Now, if you actually look at it, momentum plus value solves this problem for you because momentum is what gives you growth, right? So there's a snowball effect that's happening. It's giving you growth. While the value thing is stopping you from paying too much for a particular index. So when you keep the mix of both of them, you see that there is more consistency, more stability that comes in. And let me prove that with some data as well. So when I did that exercise and I did a simple 50% in momentum, 50% value, and I tried rolling returns across multiple periods, 15 years, 10 years, 7 years, 5 years, 3 years, 1 year. Consistently, the returns were between 15 and 16%. Now, that generally doesn't happen, right? The volatility is much higher. You have 13% in some year, 17% in some year. But how is it that two, let's call it asset classes, two sub asset classes, though both put together as a combined portfolio, are able to offer between 15 and 16%? So, as an investor, that's what we're looking for, right? We're looking for certainty, as in, if someone comes and tells me I'll give you between 15 and 16% consistently for the next 15 years, I will jump at that opportunity. So this seemed to be that kind of an opportunity for. So that's my pitch to you on why you should be having this combination in your portfolio.
No, absolutely. I mean, the first time we had a call, which was a long time ago, is the first time I actually invested in any factor-based
Mhm.
index because, market cap based is obviously the most popular option. And it just made sense, bigger the company, bigger the money. My follow-up question to that is that there are some years where, for example, certain quality index, some value will not perform that well, right? And my thought was, okay, I'm happy with 12% because I don't care about my portfolio. When I'm invested in a Nifty 50 kind of a portfolio, I don't care about the portfolio much because there's not much to do, actually. There's not much to see. I know the market will go down, it'll come back up. Somehow I felt that if I have a decent portfolio allocation to a factor-based fund, and when you say two fund portfolio momentum and value, that sounds like that's the most of the allocation. That's where most of the allocation is going to be. I may have months where I have sleepless nights. So that's bringing back to the point of, yes, I understand the data, but how does it personally affect me? How can I make that less volatile of a combination? Do you think that a 50-50 is the standard way to go? Could I split it in a way that it's probably going to be less volatile? Also, can I do factor based as a small percentage of my portfolio? And if yes, what's that percentage to, be comfortable, but also get the alpha that I'm chasing?
Yeah. So in my case, of all the money I have in equities, I put about 70% in growth strategies, uh, which obviously includes your regular Nifty market cap based indices. Most of the active funds which are there in the market are all growth based funds only. You can talk about anything other than, let's say, Parag Parik, maybe ICICI. Most of the others are into extreme growth strategies, which includes your Motilal Oswal, your Mirai, your Canara Robeco, and all those people, right? Quant, etc. So 70% of my portfolio is into growth, 15% is in value, and 15% is in bond. So the reason I say this is because technically, going by your definition, 70%, 30% is into factor-based strategies, and the remaining 70% is into non-factor based strategies. So that's one way of looking at it.
Got it. And I think even in your IPL, your Index Premium League, we saw that Nifty 50, Mid Cap 150, Nasdaq 100, even those indices were there. They were there in the top rankings as well in the final 11. So
Yeah.
what I realized is that it's not that you're saying that you just need to go for a momentum and value and that's about it. But the portion of allocation that you're putting into the factor based can be split as
Correct.
such.
Correct.
So that's the kind of message takeaway from me.
When I use the word value, it doesn't
Yeah.
mean that it has to be a value index. My
Yeah.
allocation in Parag Parik Flexi Cap is also decently value oriented. That's the way Parag Parik
Right.
as a fund house works, right? So even that comes under my value allocation. So yes, I do understand. As your portfolio increases, it becomes a kind of uh, schemes. You might end up having 30
Yeah.
schemes, without even knowing it. But then the idea is that as long as you are aware of where the allocations are, that is how much you have in growth, how much in value, how much in momentum, and likewise, how much is there in large, how much is there in mid, how much is there in small. I think you'll do pretty well. You'll not be
Right.
confused. You'll not have, and some of the questions, Rishabh, are very unnecessary. Like a lot of people end up asking me, "Am I over diversified or
Mm.
overlap between these funds?" And my answer to this is very simple. That see, I don't know what's the overlap. Number one, even if there is an overlap, you should be happy that there are multiple people who are putting their money on that same stock because they feel that probably the stock is going to go up. So you should be
Yep.
happy about it that, there are more brains working towards that particular stock because that's probably the one that's going to make money for you. Why do you want to go for a weaker stock and say, hey, what a great guy, I don't have any overlap in my portfolio?
Yeah.
That is madness, to say it differently.
Yeah, no, I agree. I think it goes into that category of what is the best date to invest in your SIP.
Yeah.
I always say you do it on your birthday, like whenever is your birthday, just pick that date. That's going to be the best date for you. You'll feel good
I,
about it.
I prefer third, fourth, fifth, somewhere on that. For a lot of people, and in my case as well, a lot of my SIPs would move from one bank account, but the company would send my money to the other bank account. So
Okay.
you
Yeah.
have to transfer the money, and in case you miss it, you miss out on even one this thing, and then you have this hassle of missing that SIP, which kind of disturbs you. So I give it a
Right.
couple of days that let me, kind of move my money from bank X to bank Y, and therefore I prefer third or fourth or fifth or something.
Yeah. And I think the second most popular question after that is how many funds you should have in your portfolio, which I think you partly answered. My answer is I don't care, but like, what's the right answer to that? Like, how many funds should you have in your portfolio?
So yeah, so I think my portfolio, I have about 60 funds, which is equity plus debt and everything put together. Ideally, let's talk only equity at the moment. So within equity, I think having 6, 7 funds is enough. I now have eight, I think eight SIPs running, 8, 9 SIPs running, not more than that. And that's where all my concentration is. So now I don't care about those other 20 odd random funds which I had bought many years back. Now my focus is around those 8, 9 equity funds. On debt, the distribution is more on again a simple thought process that hey, either I will only have safe instruments. So there is absolutely no credit risk fund in it or even corporate bonds and stuff like that. So I only have government securities, which can also include state development loans. And I have, or PSU bonds.
Yeah.
And I have your short duration instruments, which will include a liquid fund, a money market fund, an overnight fund, and stuff like that. So I don't go for the middle path, number one. Number two is I have divided that into again two parts. One is your short duration funds, which is catering to maturities which are within the next 3 months. So I don't make a lot of money on it. I hardly make 5.5 to 6%, but that's a part of my safe asset portfolio. And then the longer duration funds where you can play the interest rate cycle. So now I have the long duration funds because interest rates might go down in India starting this year. So I want to take advantage of the capital gains I can make there. So again, I think Rishabh, the big box is important, right? So now we have discussed three big boxes, right? So we've
Yeah.
discussed safe assets versus non-safe assets. So that's one massive box. Then we came on to equities where we discussed another grid, which was large cap v small cap v mid cap and growth
Right.
v value v momentum. And now within debt, we are discussing two more boxes, one being safe and short duration, and the other being safe and long duration. So, so as an investor, that's what you got to be thinking at. Everything else is going to be nothing but bells and whistles. If you have this three things sorted, life is going to be a lot more easier.
Right. And I think there's also a spectrum. Like there's a different stage at which you can explore one or more of these options, right? A lot of people might just say, I'm going to start with a broad-based large cap
Yeah.
index or a mutual fund. And then I will add this, and then I will add this. In my case, for example, I had a call with you, one-on-one call with you, after which I first time in my life I invested in a liquid debt fund. Like
Mm.
before that, I didn't even know that I need to do this. Like I could just keep my money in the bank, and whenever I can, I could invest. But then I started parking it into a debt liquid fund. So I think you reach a stage where you're like, okay, now I have enough in the bank that I need to park it in order to make something on that before I'm ready to put it in the market. But
It's a
at certain
function of
stages,
Yeah,
yeah,
it's a function of our awareness also, Rishabh. Like the first
yeah,
time we start anything, we ask our neighborhood uncle, and that uncle would always tell us, put it in LIC policy. So it
yeah,
starts with that, and then you have a little bit of awareness. You get conned by the bank a couple of times at least, where they some RM would come in, they would say, okay, please put it into this mutual fund. Next time you call it the RM, he says, I'm no longer there with the company. So
yeah.
it happens with everyone. Everyone's gone through that. I think you start becoming self-aware more in your 30s. The first 7, 8 years just goes away, without much of a financial education for us. But then in your 30s, so there's some trigger in one's life, and I think that kind of
Yeah.
stuff, that entire thing,
Right, right.
and you keep on learning over time. So that's how it always works. Even fatness was a very new subject for me. So it's only when I
Mm.
started researching for my video, I was like really amazed that there's something called factors. Slightly, it's now there in India at that time. And one went with the other. The first factor I invested was this. I think it was probably one of the first factors to be introduced in the country, which was the Nifty 200 Momentum 30 index.
Momentum 30.
Yeah, still holding on to it, and it's done well for me, right, over the last 3 4 years.
Nice. I mean, in my case, it was never an option. My uncle actually got the LIC agent to my place,
Right.
and he was like, "You have to sign here." I think they have a lot of chai together or something, like this is how you start, and then you have these levels. Like now, uh, a lot of my thought process comes from my family responsibilities now.
Right.
So it's more like, okay, I have my second child now. This is what I need to build for this child. When he's 18, he's going to get so much. Let me start building his portfolio from now on. So when the doctor called my wife, she was pregnant. When she went in the operation theater outside, I was buying like a index fund for my son. So I was thinking, this is the time, this is the day we need to start. Like, let's start early, right? So very interesting. Since you've mentioned your portfolio allocation, I also would love to ask if you're comfortable sharing the overall portfolio size and how it's split into equity versus if you hold any real estate as well.
So I do have real estate. So one real estate, one property, that's there, and then I have some money in my PPF and ETF. I have not yet counted how much that would be worth, but let's assume that's going to be pretty close to 1 CR. And the rest of everything is what I have in my investment portfolio. So that as of today morning, it's 6.8 CR. So let's assume it's 7. That's the way it's split is around 2 CR is in debt, so fixed income instruments. This includes everything that's non-equity, so a little bit on gold, which is hardly 3% kind of this thing. And then, as I told you, the short duration funds are there and the long duration funds are there. So let's assume that's 50-50. So that's how it's kind of split. FDs is very little. FDs is hardly some 3 4 lakhs. I just keep it for emergency purposes for the business. That's it. There's some chunk in my savings account at the moment because the market volatility is presenting some opportunities at the moment. So I can't use it for that particular thing. So the massive bulk is obviously in equity now, which is about 4 crores plus. And the way that's distributed is about 50% of the money is into large cap, which is a mix of, which is generally index funds and mutual funds. I don't own a single stock, which is large cap. Then you have mid cap, which is about 25% of the total portfolio of this 4.5 odd crores, and the rest is small cap. Now, what's very interesting is with large caps, the money is via active mutual funds and index funds. That's where all the large cap allocation comes in. The mid cap also is mostly around active mutual funds, and maybe a little bit of stocks might also be there, but not too many. Small caps, surprisingly, the 25% I mentioned, 22% would be the stocks which I have bought, while only 3% is actually from mutual funds or index funds. And the reason is simple that, I find it very difficult to understand large companies because they are into multiple things. They have like hundreds of subsidiaries and all that stuff. So to get a complete picture of that company becomes extremely difficult for me. However, it's a lot easier in small caps because the size is small. There's a single business that they're working on. There is no agency principal problem also because in small caps, it's normally the promoter who's also running the company as compared to large caps where the promoter is a different person and the person running the company is a different person. So, different interests are there. It's your regular principal agency problem that happens. So that's how it's split. And as I said, between growth, momentum, and value, it's 70, 15, 15. So I don't remember the exact numbers, but this is how the splitting
Got
is.
it. Amazing. I also heard somewhere that with actively managed large cap funds, you have to be careful because when you're picking them, because a lot of them may not beat the index. But you mentioned that 50% of your large cap allocation is in a combination of index and actively managed funds. So how do you choose those? Because if data says that actively managed large cap funds don't beat the index, then you have to be very careful about picking those, right? So what's like the methodology that you follow?
So there's no methodology per se here. So wherever I have a actively managed fund and it has, let's say, a chunk of its assets into large caps, that just happened by accident. So for example, I have a decent sum in Parag Parikh Flexi Cap. Now, Parag Parikh Flexi Cap, 70-75% of their allocation is actually large caps. So
Right.
But the style that they use is more towards the value style of investing. So I wanted value, and therefore Parag Pari became a choice. And accidentally, the allocation where they find value is more into the large cap stocks. So
Yeah.
purposefully, I didn't go for large caps, but through a via kind of a pass through, it happened. So I have almost zero large cap, so XYZ large cap index, a large cap fund. I have nothing of that sort. Uh, a lot of the large cap is actually in index funds now, because with that momentum, the Nifty 200 momentum 30 I was referring to, and a lot of
Right.
others. So that has kind of lopsided my large cap allocation more towards index. And whatever active is there is, it's just happened by chance. So, for example, I have a dividend yield fund. uh, you know, it's a
Right.
legacy process, been having it for many years. But
Yeah.
again, the dividend yields, you'll find a lot of this NTPC, ONGC, those kinds of companies, Vedanta kind of companies who give big dividends.
Right.
So, and those are large companies, right? So that's how it happens.
Right. I mean, so for me, what it seems like is that the layer that you care about more is whether it's growth, value. So what's the strategy? And then as a result of that, it just so happened that 50%, 25%, 25%, or is it like you care more about the 50% large cap, 25%, 25%, and then the 70, 15, 15 happens as a result? Like which layer do you care about more if you had to like rebalance your portfolio? What numbers would you look at first? Because I think it's a bit complicated to look at both of those allocations at the same point of time.
Yeah, so I look at both because now it's been a few years I've been doing this. So I do look at both. But if I were to recommend it to someone, I would probably say first look at large, mid, and small. Take care of that allocation because there's a lot of historical data between how a large cap performs, how a mid cap performs, how a small cap performs. That way, value momentum is slightly new for the Indian landscape. So there's not as much of data there. So focus more on the large, mid, and small initially. And then as your awareness grows, that's when we can move into,
Yeah.
have an element of growth value.
Right. And within the small cap, you said 22% of those are individual stock picks. And because I read your newsletter, I know the kind of research and the work that you do to actually make those bets and make those decisions. Even though I personally don't buy individual stocks, but I love reading those articles that you send. So if someone wants to really get the deep dive analysis, I would highly recommend your newsletter. But why not more? Like the way that you do your research analysis, why wouldn't you bet more, like a 50% into your stock picks versus 50% into funds at your experience and your kind of research? Why would you only limit it to 25% of your portfolio?
So that's the number now. I'm sure
Yeah.
will go up over time. So maybe over time, this might become 33, 33, 33.
Mhm.
There's fair
Right.
probability of that happening. In fact, because you mentioned the newsletter, so my stock portfolio now is about, I think, 1.3 CR. Out of that, about 30 lakhs is attributed to my newsletter stocks itself. So when I say
Okay.
that these are my newsletter stocks and I've written that article, so just to put skin in the game, I also kind of make sure that
Mm.
at least 3.5 odd lakhs per stock is actually here. But then yes, I'll not be blind to it. I would increase allocation where I want to. I will decrease. I've even exited now 3 stocks. So out of the 10 I have mentioned, I wrote that article on. I have kind of exited 3 of them. So I'm using my kind of awareness, my research also along the way. But yes, to put skin in the game, I do have about almost 25% of my allocation within stocks. That's to my newsletter. This thing, and this is what I'm going to increase over time. So when I have
Right.
more research coming in, when I have more stocks into the newsletter, that itself by default will see a 3, 4, 5 lakhs per stock kind of a investment from my end. So I'm very committed to that.
Right. So I think now we have a fair understanding about your portfolio. But now let's go to the average Manish, right? So Manish is Manish has a job. He's making 50, 60,000 a month, let's say, saving around 30,000, spending half of it. Ideal scenario. What's the path forward? I know that we have spoken about the example where you invest 30,000 a month. You have like a 10% or a 10,000 step up every year, and you can reach your 10 crores fairly well if you provided that you can increase your income. I think that's one thing that you've also mentioned. I've also mentioned in my videos that provided you can increase your income. So, how much should be the focus on learning about investments, adding different asset classes, and increasing the alpha overall versus how much should be the time, energy, and focus investments, given that we're all human at the end of the day, on increasing income? How do you balance that? At what point do you then decide that now it's the time to add, for example, some stocks from Shankar's newsletter? Because I think that you have to reach a certain stage to actually be able to do that as well. Most people like commenting on my videos don't even believe that compounding is real. So, like there's different kinds of people out
I've
there.
seen the videos, right? SIP is fake, compounding is a joke, so anyway, I subscribe to it. I've seen the benefits. So there's a big difference now, right? I mean, content is like a different story. Investing is a different story. Life is a different story.
Yeah.
Some of the content really surprises me. How people twist the facts in a way that. But thing is, Rishabh, they don't make a very compelling case. Also, I mean, when I'm going through it, I'm like, okay, some of it is nonsense. What they're trying
Yeah.
to impress people with. But yeah, that's the way things are. Yeah. So
Yeah.
on your question, I think. As we discussed earlier, the income part is obviously very, very important, and that's how things should proceed. But if there is this person, and let's say the money that he's able to save is about 25,000, uh, all expenses are all taken care of, so about 25. Uh, I would definitely, kind of advise that person to start looking at a nice mix of maybe five SIPs. So put 5,000 in five SIPs. Keep that mix of large cap, mid cap, small cap that we discussed. So if I have to name a few funds, I'll probably, at the top of my head, I would say Parag Parikh Flexi Cap. It's done well over the years. Somewhere Rajiv Thakkar and team really kind of thinks through the situation. I would definitely advise a momentum fund. If can either be a Nifty 200 momentum 30 or it can be a Nifty 500 momentum 50 as well, which takes care of the entire broader scenario. Then I would suggest a mid cap fund, can be anything, but ideally it'll be a growth fund, can be an Axis mid cap or a Motilal Oswal mid cap or stuff like that. One small cap fund should definitely come in. And the fifth one is like, your trump card. You can do it for anything, whatever works for you. I would ideally say use it for a Nasdaq 100 or an S&P 500. So get that exposure there. So if you really look at it, how I've done it is I have actually done my 50, 25, 25, and I've also done my 70, 15, 50. How I've done it,
Exactly.
your large cap, your the first two are taking care of your large caps quite sufficiently. The next one takes care of your mid cap. The next one takes care of your small cap, and then the Nasdaq 100 is again more of a large kind of a thing. So somewhere that 50, 25, 25, or it's not a 50, 25, 25, at least a 60, 20, 20 is coming into the picture. Again, from a growth aspect, the first one is value, which is Parag Parikh. The second one is momentum. The third one would probably be a growth. The next one would probably be a growth, and the last one would be a mix of value and growth. So
Yeah.
somewhere that 70, 15, 15 also takes care of. So this would be my advice to a regular Manish on how he should look at his equity investments.
Love it. So Parag Parikh, Flexi Cap, one momentum fund. I think Nifty 200 Momentum 30 is the one that comes up when you look at all of the data as one of the best performing momentum funds. Then you have the Axis Mid Cap Fund, which is one of the funds that I've been looking at as well. Then you have the Small Cap Fund, Nasdaq 100. One quick question on the Small Cap Fund. Would you go for something which is more active, like a Nippon India Small Cap Fund versus, let's say, the Nippon India Small Cap Index Fund, which is the 250 index?
I would prefer an active fund over an index fund. I have both, but
Yeah.
if I choose one, I would prefer the active fund because the space is expansive, right? For a mutual fund manager to choose. He's got 250 small cap companies to work with, plus he has the micro cap companies to work with, right? So
Right.
there's a bigger chance of him making alpha.
Right. Now let's move to, Manish becomes successful and, things are going good. He's able to build a side hustle. Maybe he started freelancing. Maybe he started educating people. Maybe he became a content creator. We don't know what, but, Manish got successful. Now he started thinking about fire, right? So now he started thinking about freedom and independence and all of these dreams. You have personally mentioned that you've changed your perspective on fire. And I would like to understand what that shift has been from what to what. And what are your thoughts on the 4% rule as well? Because this is something that you mentioned in one of your videos.
Yeah, so maybe it's a bit on the cultural upbringing, or the kind of personality that I have, that I think, I really want to work all the time, right? I don't want to kind of have that vision in my head that, I've made money and now I'm sitting on a beach sipping pina colada. So that doesn't work for me, right? So where I've kind of done that twist is that what kind of work I want to do. So I wanted to move away from a salaried kind of for this thing where, it's like partial servitude, so to speak, where, your boss or your shareholders are basically telling you what to do. They call it empowerment, but actually they are kind of robbing you of your powers. And so I said, okay, I want to do something which I really like. And that's where YouTubing happened. That's where, my newsletter started. So see, I was able to decide what I want to do, how I want to use my work hours. I want to shape my destiny. And for me, that's how the fire thing is kind of moving in. That you don't retire, but you actually change your goalpost. That you can do something that
Right.
you really enjoy, which is still work, which still gets you money, and probably it gets you even more money than what you used to make earlier as a salaried person. So that's how I'm thinking of on this 4% rule. It generally is a little shaky because what 4% rule is also telling you that, hey, you've got to be bounded by that 4%. You can't have more expenses or less expenses or something. 4% is 4%. Otherwise, it kind of messes up the calculation. So what I generally do is I would put everything in a worksheet. I'll try and work it out myself. And what I also like to do is, something that we learned in our value investing classes called margin of safety. So I always assume that there will be some mess up that might happen or some errors that might be in one's calculation. So, keeping that in mind, whatever number I get, I top it up with another 20-25%, saying that, okay, there might be a
Yes.
25% error that might do. So let's account for that as well. And then I come up with my numbers. That's
Right.
how. So not a big fan of this 4% thing in isolation, number one. And for fire, it's more about financial freedom, but retire early doesn't kind of come so much in the picture.
I think there's also a point when you reach a stage where your passive income is enough to cover for your lifestyle and also for your investments. I mean, that for some people, that could be a point where they consider themselves as retired or slash doing the things only that they love to do. It could also be something where you say that now I will only do things that I really want to do and I will stop doing anything which I don't want to do. I mean, that could be like
Yes,
one variation of
way
retirement.
passive income, people have different thoughts about it. So, for example,
Yeah.
for 99% of the people, passive income is, hey, I've put in capital in a stock and it's giving me
Hmm.
dividend, or I have bought a few properties and it's giving me rental income. I really don't qualify that as passive income
Hmm.
because you've put in capital, right? You've put in a few crores probably to get that level of rental income, and yields being what it is in India, it's hardly 2 to 3% for residential property. It's a lot of capital that you've put in to get some respectable or passive income there. For me, passive income is you've done the work once and you continue to get it. So for example, what you are aware of, in terms of affiliate income, where you've done the work
Yeah.
once and you're getting it. For me, YouTube gives me passive income. It gives me about 70,000 rupees irrespective of whether I post a video or not. So the old videos which I have, that gives me, 50, 60, 70,000 rupees a month, like clockwork. So
Right.
that's passive for me, right? So because I don't have to put in more effort around it. So
Yeah.
that's what I really define as passive income. What I get from my portfolio, what I get from my rental property, etc., is all okay. But if you've reached a stage where you can make, let's say, a couple of lakhs from this passive income, the way I define it, I think that's when you can say that things are sorted because you got multiple streams of income and everything is kind of taken care
Right. Alternatively, maybe a business like a SaaS product or something
of.
where people are subscribing to your product. I also think of this as like two different buckets. One is like the traditional passive income where people used to buy properties and put them on rental. But they had a portfolio already to actually start making money from it. And then there's this modern digital passive income where you can create digital assets and then they drive income for you. I mean, you're still building assets, but you're building it through your hard work and your effort
Yeah,
or through leverage.
free, right? It's
Yeah.
like a lot of people, like Amazon has this affiliate program. You can just sign up
Yeah.
today. 2 days you get your approvals, and
Yep.
all you need to do is to get other people to click on a link, right? And that's
Yep.
that way of earning money. So I've tried it just a little bit. I get about $1,000 a month or something like that. But that's still okay, right? So it's at least,
Yeah, yeah, yeah.
so that's how I made my first rupee online. So before you do it yourself, you're always under that impression that hey, it's impossible to make money in the internet world. Maybe that was thought maybe 10 years back. Now it's stupidity to think like that because most of the revenue that gets created across the world is probably more online rather than offline. But
Correct.
then once I got that first rupee from my Amazon affiliate link, I think that gave me a kind of an assurance that, hey, this is real and there's actually money to be made. So that's something even a 20-year-old can start, right? Building affiliate income or doing something where, it kind of opens up a stream of income for you and you can keep on earning from it for the rest of your life.
In a recent podcast, I was saying that it's much easier for a 20-year-old to make more money online than like save more money. So all of this budgeting and stuff will happen, but if you can make more money, like that's the easiest lever that you can pull. The other point that I had on that is in terms of retirement, your personal goal post, and where do you think you're on that spectrum of the lean fire, fat fire? Do you even calculate yourself
No, I don't.
in those terms?
No, I don't. I don't. I
Okay.
moved away from having a number in my head.
Yeah.
The portfolio is pretty good for my living standards and what I envisage my needs would be over this thing. So I've already kind of somewhere close to that stage or probably already reached that stage as far as I'm concerned. What makes me even happier is that there's now a lot more upside than what I had in my first 20 years of work. That's what gives me that confidence that what I'm doing now can actually be 5x of what I used to make when I was working in my last job at ET Money. So those
Right.
plans have been put into action now. So the next 2 years, we'll know exactly, how much I've been able to kind of build an upside for myself. So that keeps me more excited because, you know, today having an able body and a proper mind itself is an advantage. You're a bit fortunate to actually have that. Plus, on top of that, if you have a portfolio, if you already have a vision for yourself wherein you can probably 5x your income from here, that itself kind of puts in a lot of confidence. And that's what I try and tell everyone that this is the wealth you generate. That
Yep.
if you have that vision for yourself, I'm using that word once again. If you have that growth mindset that, hey,
Yep.
I don't have to be stuck at where I am. And if I make just these small changes using the same 8 hours a day that everyone uses, I can do so much more. That itself is a big asset, so to speak, in today's world.
Nice. I think in one of the videos you mentioned also, like you gave an advice for people to create an upside. And you had also mentioned that I believe your YouTube income was around 57 lakhs or so last year, and you almost doubled it from the year before. So you were giving an example of how YouTube created this upside for you. If someone is in a job, right? So like many people are in a fixed job and they are watching this video, what's the way to create an upside for them that they could consider?
So it kind of moves into their passion. So that's very important. But at least from a content perspective, there are, today on content, everything sells. You take your camera into a restaurant and you show someone cooking food. And somewhere I see even that has become like 1 million views or something. Someone is making omelette and, that itself comes. So it kind of sticks to your passion. But if you have a passion, so let's take something. Let's take cooking as that example, right?
Yeah.
So if you like to cook, you come back home, you set up you already have a nice kitchen probably if you love to cook and start shooting those videos there. Now, what are the various avenues which are there? You can create recipes, that you can teach people how to cook these recipes online. That's one way of doing it. You can build it in the form of a newsletter kind of a thing, wherein people can this thing. You can take in classes. You can take online classes. You can take physical classes. If not physical classes, you can definitely take online classes. That's possible. You can build a community out of it. Who knows? This might get you into a cooking show kind of a scenario. There might be people who will come and say, "Hey, I have this nice rice cooker which I want you to promote. Please show it
Yep.
as a part of your this thing." So you can see, right, that one passion of yours can lead to so many different deals. The brand deals can come in. There's tons of stuff to actually do. You just have to put in those 3-4 hours of effort a day extra to do it. But if you do this consistently over a 2-3 year period, you'll see that the income that you make from here will be far higher than what you make from a primary job. And I know many people who have kind of made that switch after they've seen that their side hustle, their side hobby has done a lot more for them in terms of money.
So I like this concept of like having one passion and multiple revenue streams around it.
Yeah, so that's how it should be, Rishabh. That's the best way of going around it. And even if I take my example, I have stuck with this. So, people call me a content creator. Content creator is a secondary thing. Actually, I look at myself as a researcher. And when I had that
Mm.
researcher mindset, I said, okay, I'm going to use research as my core and I'm going to create a YouTube channel. Then I said, I'm going to use research as my core and I'm going to create a newsletter. I'm going to use research as my core and I'm going to create a community now. So see what's happening. I have one single skill, which is research.
Right.
And I can use research in multiple ways the way I want to do it. So that's exactly answering your point that have that one skill, but maximize that skill into multiple income streams. That will give you a lot more.
I would love to like now talk a little bit more about the community, and because I think that at least me, I'm super excited whenever your community launches to join, and I think there are people on this channel who will be, also excited about that. So, what's the plan for the community? When is it launching? How can we get early access?
So the community will launch sometime this month.
Nice.
It'll be more of a alpha launch kind of a thing. So I'll not open it to the world. I first want maybe 100 people to join it first, and we'll work out things. I want to kind of make sure that there's a lot of participation among people who join in. So the early adopters, they are the ones who are kind of driving this entire community. Now, for me, the best way of learning investing is from learning from each other. And I as a person can't be good at everything. It's really not possible. And if someone says I'm good at everything, person is probably lying. Okay, so I want to kind of build it around that okay, I'm a facilitator. I'm the administrator of this particular community. So I will make sure that there is enough stuff here that can be consumed by people. But I'll also encourage more and more people to come in and participate. So for example, if I want someone to teach me about marketing and growth marketing and consulting and stuff like that, I'll probably invite you. So I'll say, hey, Rishabh, why don't you come in and you explain how things work in this particular industry, and then we'll connect it with a stock. So let's say there is some stock
Right.
into this thing. We'll connect it with the stock. We'll get that investing thing across everything that we work on. And the flavors are simple. So there's going to be a kind of a research module where I have my newsletter research. I have more research that comes in. And we keep on updating those stocks because that's a question that everyone who has read my newsletter has. Because a lot of people do invest after reading my newsletter. And then they're like, okay, Shankar, ध्यान रखोगे ना अगले 3 महीने बाद ये होगा. So I have to kind of be honest with those guys as well. So that'll take care of that. The second part, which I'm really interested in, is my daily discussions. So, because me, Priyam, my researcher, we are reading every day, we're reading 5 hours each. We get a lot of stuff which might not be worthy of a newsletter, but it's worthy of a discussion. So, I'll give you an example here. So, SpiceJet. Now, if you open the BSC India website and you go to corporate announcements of SpiceJet, you'll only receive good news. Oh, they have done this. They have given money back to the lenders. They have settled with this particular lender. They have, they want to do 50 more aircrafts in the next 2 years. They'll be profitable, blah, blah, blah. Okay, so there's a lot of stuff. Now, I was reading through it. Priyam was reading through it. And we were like, SpiceJet looks like very interesting at the moment. When suddenly one of us asked this question, okay, this guy wants to increase his flights from 30 to 50 over the next 6 months, but where are the planes? And then we went back to Boeing website, Airbus website, and we figured out that these guys have their hands full, and the next set of orders they can take is as of 2029. So that gave us a second layer of thinking that hey, it's not about what the management is saying or where it wants to be. There is an important supply side when it comes to aircrafts, and if there are no aircrafts in the world, SpiceJet cannot add any spice to their life because it's just not there, right? So ambition is something else, but the realities are different, and we find tons of such examples. There was another one, Craftsman Automation, very recently. Looks really great from a top line perspective. But then when we added the depreciation increase, when we added the interest cost, etc., we felt it's not as good as what it seems. It's not worthy of a newsletter kind of a review. But it's important
Right.
for you and me to understand this, that if your interest plus your finance cost is a large chunk of the EBITDA, then probably it's better
Yeah.
to avoid it because this is not likely to become a multi-bagger. And then we tried it
Yeah.
back into Screener when we put the same equation which I told you, and we figured out that in the last 10 years, only two or three companies, where the interest plus finance component is high, they have done more than 20%. But the reverse scenario, it's like 40 companies which have delivered
Mm.
more than 20% returns over the last 10 years. So these are things that we pick from time to time, and this encourages a lot more discussion with people.
Yeah.
Someone else will have a different take on this. So we want to encourage that. Another module we want within this community of ours is events. So again, a lot of, and we want to run sprints basically. So let's say Rishabh, you are someone who's interested in so you want to learn how, let's say, future EPS is calculated, right? It's a very important thing for us to calculate. So we'll have sprints where I'll give you a homework saying, okay, please read this particular transcript. It's 14 pages long. Take a week, no problem. Next Saturday, between 12 and 12:30, we're going to have this call. We're going to do a walkthrough through the entire thing. And let's see if what you have calculated matches up with what we have calculated. So that's a great way of
Nice.
learning, right? So you have this participative kind of a thing that comes in. And feel free to argue your point, saying that no, this is what I think is going to happen here because of these 4 points which I read as a part of the transcript and some extra information that I figured out from Google or from DeepSeek or somewhere.
Right.
The more you learn through this participative kind of a thing, I think the more you can understand investing and be a much confident DIY investor. I find it a much better format as compared to, let's say, a course where this
Yeah.
guy has just put it in and he's out. It requires a lot more effort from my end because I have to be dedicated to this all 365 days, which might sound stupid to a few people saying that, why do you want to do this? I want to do it because exactly what we discussed a while back, right? Because I have my portfolio in place and everything. Now I want to do what I want to do. So I prefer to do the hard work and make sure that I can get at least 1,000 other people be very confident about their investing. So that's what the community is there to achieve.
Absolutely agree. There's a lot of hard work. So last year, I'd launched a community for growth marketeers, and it lasted only 365 days
Okay.
because of the amount of time that I could actually invest. Also, I had my second child, so I was like, okay, you guys paid for 1 year. I'm going to give you value for 1 year, and then at some point in my life, I will come back to it. But I really like the module which is about learning. Right, that's the main thing that attracted me as well. Like you mentioned some simple thing about calculating future EPS, etc. And I think in one of your videos, you were explaining how Screener calculates the P by E ratio, which is like different from how it's, yeah. So like those kinds of debates and discussions really like they spark the brain, they enlighten you, you learn something new, even though I'm not looking for a stock pick, to be very honest, but I would still join it for the learning. For someone who is not actively investing, whether passively investing, even these guest sessions that you spoke about, someone coming and speaking about marketing, it's again improving your skills so that you can improve your potential, you can make more and fuel your equation of long-term compounding and growth, right? So, and your audience has asked for it. In growth marketing, we always say, look for what the audience is asking for first. So if people are already saying, Shankar, let me know after 3 months, this and that means they need a community more than a course. They need to be part of an ongoing conversation where they could have a platform to ask questions and so forth.
I'm sure
So,
people will come in for the content, but what I
yeah,
really want is they should stay for the community.
right, right,
That's really what I look forward to. So you can come in for the content, not a problem, and you'll
right,
enjoy the
right,
content. But I wish you stay for the community because that's where the
yeah.
real benefits are.
Right. So, absolutely a pleasure having you, Shankar, and looking forward to the community. Not just myself, I hope a lot of my own people from my channel also join this community and we can have some more discussions together. So, let us know whenever there's the early launch option. I'll be happy to push it out on my channel and newsletter as well. And once again, thanks for your time, Shankar.
Thank you, Rishabh. Pleasure having you.